To everyone who has joined us tonight, I hope you are all staying home and staying safe. As always, we are excited to welcome all of you to Prosper with Us. I am Ping Mei, your host for tonight. Tonight's topic is a very important one for any new investor who is just getting started on building their portfolio. Learn the do's and don'ts of buying your first investments from two very experienced investors, Sabun and Tim. Now, just a very quick introduction about ProsperUs for those of you who are new to us. ProsperUs is a new digital investment service by CGS-CIMB, the #1 broker on SGX. We are a team of passionate millennial investors who are bringing to you a multi-asset, multi-market investment offering to help you build up your long-term wealth portfolio. Our platform offers 8 types of products and covers over 30 exchanges globally. We are committed to bringing investor education to the forefront of ProsperUs in everything that we do. We are not here to encourage you to trade more, but we are here to educate and share investment knowledge and insights with you to empower you to make better decisions for yourself. Most of you returning attendees will already know Tim, who is our long-term investing guru. He has over 10 years of experience in financial markets, and his last stint before joining us was at the Motley Fool. Tim is an active investor and can talk about stocks for hours. His passion for investing is an asset, and he's excited to play a part in grooming the next generation of investors. Tonight, we also have, for the very first time ever for our ProsperUs webinar, our Chief Investment Strategist, Sabun, who has over 40 years of experience in financial media, banking, and finance. He's been there, done that, and has a lot of knowledge and wisdom to share with us. The key question tonight is, can you have a $1 million portfolio of investments on retirement? Well, it depends on how much you're willing to save and invest. How to start, when to start. Well, as those Nike ads say, just do it. And to start things off, let's have one quick poll question. If you could all quickly answer. Do you currently have investments? Just trying to get a sense of the audience that we have tonight. Are we all really new investors, or we have a lot of people who've really sort of jumped in and made that first investment? All right. And we have the results. Well done. 96% of you do already have investments. Only 4% are literally new, first-time investors. Very well. Then I shall pass on over to Sabun and Tim, who will now share with you the basics of starting your $1 million investment portfolio.
Thank you very much, Ping. So I'll take it over from here, all right? Hi, good evening, everybody. Let me start by saying that making money is not easy. As Ping said, I've got 40 over years of experience and I've got lots of gray hairs. So don't believe the quick money, easy money gurus out there. Look, all they want is a big fat investment seminar fee from you. If they were that good, they don't need your fees. So making money is not easy. And the sooner that we accept that, the quicker we can get around to the serious business of making money. So how do we do it? Well, as Nike says, just do it. But how? Well, you start with a budget, a savings plan. So I'm glad that the majority of you already have investments, but you might want to think about this. How much more should you save? How much more should you invest? So how much should you save per month? Well, we'll look at the average Singaporean based on survey data from the government. The average Singaporean saves, now wait for this, 58% of their monthly income. Now, how do we relate this to the global sort of the average, if you like? Now, do you know US Senator Elizabeth Warren? Well, she was in the running to be the Democrat candidate for the US presidency last year. But anyway, that's another story. Elizabeth Warren, in another career, was an academic, and she wrote books on personal finance. She made famous the 50-30-20 rule. That was in her book, All Your Worth. Now, 50-30-20 refers allocating, or her advice of allocating your after-tax income as follows: 50% on your needs, 30% on your wants, and 20% to savings, 20% to savings. Now, how does that fit in with the average Singaporean 58%? Now, interestingly, the average Singapore experience is not that far from Senator Warren's advice, 58 to 20. Now, how do you bridge that? Because Senator Warren's advice, if you exclude forced savings under the CPF scheme, looks a lot like the Singapore experience. So if you exclude the 37% contribution rate in Singapore for the CPF for the under 50s, so you get 20% from your employer, 17% from your employer, and then you cough up 20%, so that's 37%. So your 58% average savings for the Singaporean minus 37% and forced savings is 21%. So that's roughly the 20% that Senator Elizabeth Warren wrote about. Thank goodness for Singapore CPF. So, okay, let's use that as a benchmark. So you save another 20% of your monthly after-tax income. Don't include your CPF. You take another 20% off, right? So that's a starting point. So thank goodness, again, that Singaporeans don't have to pay a lot of tax. Now, I did some rough back-of-the-envelope calculations. If you had an after-tax income of $60,000 a year before CPF, and you invested that every year, right? 20% of that every year, 20%. So you save 20% of that 60 and you invest that every year and assume you get an average return per year of 5%, 5% per year, compounding. In 28 years, your zero value portfolio today should be worth about $1 million. And I say should be, could be, because there are assumptions here on returns rates. These are the sort of rough numbers that you're looking at. And guess what? You could have $1 million portfolio and still leave your CPF ordinary account alone for payments for a property. So that's the enabler, the savings part. You're now ready to start, ready to invest. A few basic questions. Number one, which markets? My simple suggestion is that if you're starting out, start out with the markets you understand, markets that are backed by sound economies, stable politics, properly managed and governed companies. Sure, there is going to be a lot of interpretation of what is a sound economy and what constitutes stable politics. So I'll share my opinion here. You can do a lot worse than to start with Singapore. That is your home market. Huh? So it's a good place to start. And after that, after you have established your investments within Singapore, and notwithstanding the economic problems we hear about just about everywhere these days, you should consider the world's 4 largest economies. They are US, China, Euro area, and Japan. That's the answer to the first question of which markets. Second question, do you start with stocks or with exchange traded funds or unit trusts? Unit trusts are also called mutual funds, of course. So unless you are already an experienced investor who have a fairly large amount to invest, I would suggest that you start with ETFs, exchange traded funds. Now, that way you can get a great deal of diversification for relatively small amounts of investments. And that's because of ETFs, exchange traded funds, typically mirror a whole market index. You don't have to worry about stock selection. So stock selection can come later as you gain experience and as you have more funds to invest. So sure, when you have more experience and you have more funds to invest, by all means, you can start to take an overweight position in specific stocks that you know, you understand, you're comfortable with. So what about unit trust or mutual funds? Well, that'll give you diversification as well. But I would recommend that for later as well, because not all unit trusts are worthy of the management fees that they charge you. The truth be known, most unit trust performance only mirrors the benchmark index. So after taking out the fees for the manager, if they follow the benchmark index, after taking out the fees, their performance actually falls behind the index. So ETF, exchange traded funds management fees are generally much lower. So that helps them to track the index better. So just as stock selection is important if you're going for single stocks, fund selection is also important if you're buying unit trust or mutual funds. So let that come when you have a little bit more experience. Finally, the third question. How do you build a lit portfolio or a portfolio of any kind, right? Well, you're back to that Nike question again, or that Nike slogan. Just do it, right? If you're young, and most of you here I assume are young, just do it. Start with stocks, as I said, via exchange traded funds at first, and maybe later through unit trusts and single stocks. Once you have built up that stock exposure, some momentum through ETFs, start thinking about bonds. Bonds can come later because you're young. You can take risks, right? Bonds are lower risk stabilizers. And when you eventually have enough stocks and you want to have that sort of diversification, that safer stabilizer, do that through ETFs as well, exchange traded funds. And later, you can do it through unit trusts or bond mutual funds. Now, most individual bonds are for so-called accredited investors. They are people with considerable income and they have the assets and they have experience to qualify as accredited investors. Retail bonds, the retail bond market is there, but the offerings are quite limited. So consider unit trusts, mutual funds, or through ETFs. Then as you grow your portfolio, your lit portfolio, you can add so-called alternatives, fund of hedge funds, gold, commodity funds. You've got so much more choices. So these are the three things that I would like you to think about in growing your portfolio. So look, I think I've run out of time. I want to leave enough time for Tim and for you to ask questions and to discuss. So I'll hand you back to Ping or to the MC for the event. Ping?
I think Tim's gonna take over.
Oh, Tim then.
Hi, everybody. I'm just sharing my screen now. So yeah, thanks for that, Seiboon. I think that was a really good primer for what you should do when you do start. And I do agree with Seiboon about starting with ETFs. I think that is the best way to actually begin to become an investor for the long term, is to start with ETFs, because it's very accessible and it's broad-based as well. So I'm going to move on to how we can actually start building a lit portfolio from the ground up, because the question I get a lot is that people don't know where to begin and how to start, and it's always a bit of a headache. So I think understanding where you can find ideas and how you can construct it is something I kind of want to share with everybody. So go through the standard disclaimer for compliance purposes. This is my own personal opinion. It is not meant to be construed as financial advice, etc., etc. And before we go into investing, I think we should just revisit my checklist of the 5 key points of sort of getting your finances in order before you invest. So I think number 1, have an emergency fund of at least 6 months, if not 12 months, if you're conservative, and that's purely in cash. for medical emergencies, or if you suddenly become made redundant or unemployed, you have that cushion, so you don't need to cash out of your investments, which I think is the last thing you want to do. Number two, don't ever borrow to invest, or in the financial parlance, margin, go on get margin, because I think that's going to leave you, obviously struggling if things go wrong, and it can go wrong very quickly with margin. Number three, I think aim for a minimum holding period of 5 years, because I think when you're investing, you want to think longer term and not be swayed by the day-to-day or even month-to-month movements of the market. And accept that goes hand in hand with number four, which is accept that volatility is just normal in the stock market. It will be there, and it has always been. And number five, don't try to time the market. It's quite simple. You need to stay invested over the longer term. Okay, so how do you start actually investing? That's a key question that I get a lot. A lot of people feel lost, no clue where to start, don't know what to do, or where to begin putting their money. And my advice to them is to have a plan, and kind of stick to that plan. What are the main options? What are the main asset classes that, obviously I think Se-Boon had touched on? You have individual stocks, you have exchange traded funds, ETFs, you have mutual funds, also known as unit trusts. You have, bonds, you have real estate, which I think you could probably put real estate investment trusts into that bracket as well, REITs. You do also have cryptos that's out there, but it's becoming a much more mainstream asset, I guess, but it's still very, very volatile. So, you have an idea of the asset class breadth that is there, but most people obviously go for the first three. If you're young, you want to be in equity markets because you have the time. You have the time horizon to sort of make money, right? So that's the whole point. And so DCA, what does that mean? That means dollar cost average. So that means basically putting in a little bit of money every so often on a regular basis. So that might be every 2 weeks, that might be every month, that might be every quarter. But what you're doing is you're not putting a massive lump sum into the market. So I think there is a lot of data out there and a lot of, financial sort of studies that have been made that obviously lump sum investing is actually more beneficial over the long term. If you put a massive amount into the market in one go, it tends to actually work out better over the long term. But having said that, that's also putting you at a disadvantage because you have to be mentally prepared to put that amount of money to work in one go. And so that's really, really difficult to comprehend, I think, for a lot of people. So even dollar cost averaging, your returns might not be crazy in terms of 20, 30 years compared to a lump sum, but I think it gives you a good base to start that methodical sort of investing approach where you get into a habit. And I think the great thing about investing is it needs to be habitual. It needs to be a habit that you're used to and that it just happens automatically. It's almost like when you start riding a bike again, or if you drive, it's almost second nature. So when you get, I don't know, your monthly pay, maybe a portion of that goes into an ETF or it goes into whatever you decided to invest in. And you can kind of mentally think that portion of your salary, that portion of your monthly pay has gone towards investing, and then that will stay there for however many years. So I think that's a great way to think about starting, is just to start slowly putting in money through a dollar cost averaging strategy. But there's nothing to say that you can't actually use a combination. So, I mean, for one of the worst decades on record for stocks, which was the 2000s after the dot-com bubble, DCA actually won out over 10 years, over 9-10 years. But it was not by that much, but there's nothing to say that you can't use a combination of both, lump sum investing and DCA. So DCA, I think, is more about putting in monthly or putting in, every quarter regular contributions. And then when you do have cash, maybe you've got a bonus, maybe you've, just happened to come into some money, maybe you don't know what to do with it. Maybe then you can start putting it in, but have a plan with it. Don't go all in maybe, or, have a third here and then maybe put a third in 6 months or in 12 months, have a plan to how you want to put that money in. But I think there's nothing to say that you can't do both. So I think there's always this dichotomy between, do I put in monthly or do I put in a massive amount of money in one go? So I think there's definitely a case to be made that you can actually do both. and just do it on a regular basis, right? I think that's the whole point. As you can see there, this is after the financial crisis bottom, but you would have had to have timed the market in 2009 and been willing to buy when everything was red, right? And how many of us are willing to plow in a massive amount of money when everything is everything's being sold off? So it's very difficult. I think it's more of a mental barrier to us, and I think dollar cost averaging kind of takes that emotion out of the equation for all of us. And this is the thing. So when markets are falling as they have been recently, we automatically think we should get out and we should sell, right? And we need to think, no, we should stick to the plan and kind of have eyes on the prize and keep going, right? So as the market falls, maybe you can be buying more on a regular basis, which is great, because if your time horizon is 10, 15, 20 years, actually you don't want the market to keep going up forever, because it wouldn't make sense, and eventually there would have to be some sort of correction. So a correction is actually quite a healthy part of the stock market, and it happens on a regular basis, right? I think a 10% correction happens on average at least once every year, and 20% correction happens every sort of like three or 4 years. So it's a very normal part of a stock market cycle. So don't panic sell and get out. Just think about what you're doing on a regular basis, what you're contributing, and I think that will help you sort of become accustomed to the habit of investing on a regular basis, which I think is really, really important. Okay, I'm going to sort of do a poll here, kind of break things up a little. Wanted to hold on a minute. Okay, sorry, let me end that poll. Okay. Sorry. Okay, I think that poll doesn't seem to be working. Okay, maybe I'll move on. Sorry, the poll seems to be oh, there we go. Sorry, that's the poll we wanted. So how many stocks are you holding currently? And then also how many ETFs are you holding currently? Just kind of vote quickly just to kind of see where we are at. Okay. All right. Okay. Okay, cool. So let me kind of share the results there. Okay, so I think we can kind of see that most people are holding sort of in the stock category, sort of 1 to 3, although it's pretty evenly spread. And then also the ETFs, 1 to 3. So I think there's a case to be made for having obviously more stocks than ETFs. My own personal opinion on actual stock numbers is, for a personal investor, you're very different to a fund or an institutional investor. So you actually should technically have less than they would currently, typically hold in a mutual fund. So I think the ideal number of stocks, eventually your goal, I think, should be around 20 to 25. But I think if you're starting, you can identify sort of maybe 5 to 8 stocks that you want to start positions in, or you want to get comfortable with, and then start to build from there. But eventually you do want to become, get to maybe sort of 20, 25. So you've got a bit more breadth, and obviously there's not so much of your wealth in one company, which is obviously quite, there's that concentration risk, right? So you definitely need to spread that out. I don't know what you think, Seiboon. I mean, that's my opinion. I mean, what's your thought on the number of stocks and maybe number of ETFs? Obviously, the ETFs, I think, would be a different prospect just because they're baskets as well.
Sure, Tim. Look, I'll go back to my earlier point about how unit trusts or mutual funds, the vast majority of them do not outperform the benchmark index. Do not outperform the benchmark index, and that is statistically proven. The majority of them don't outperform the index. The reason is because they hold so many stocks, right, that they essentially become the index. Yeah. They hold so many positions, 50, 60 stocks. They start to reflect the index. So it's very hard to outperform the index if you are the index, right? so you can't beat yourself, right?
Yeah.
So, and after deducting fees for the people who manage the fund, you underperform the index. So if you're going to hold that many stocks, 50 stocks, you know, it is arguable if you might just want to buy an ETF instead, right?
Yeah. Yeah.
Yes,
Exactly.
you pay some fees, but they're not very high fees. You might as well just buy an ETF. So 20 to 25 stocks in a mutual fund sort of scenario is regarded as a high conviction portfolio, right?
Yeah.
So, meaning most mutual funds don't have very high convictions. They just buy so many stocks, they mirror the index. So, if you're going to buy individual stock, yes, it makes sense as you get more experience to just buy some 20 stocks that you know, you understand, and you're prepared to hold for a very long time.
Yeah. Yeah. I think also I would add to that as well that obviously mutual fund managers have like teams of research analysts and to follow these companies, and you as a personal investor, as one person, you can only follow a finite amount of companies, and you can only research and be sort of familiar and intimate with a finite amount of companies just because of the time constraints that you have as one person. So it will be a very different approach to a mutual fund manager in that sense, and sort
That's
of
it.
a larger
That's right, Tim. So I think 2025 may be an optimal number for an individual. You don't want to have too few. So
Yeah.
say if you had as I see from the polling, the greatest number is concentrated in 1 to 3. So if you had 3 stocks, each stock is 33% of your portfolio. So if that one stock didn't do well, that's 33% of your portfolio down the drain, right?
Yeah.
So you don't want to be that concentrated, right? So I think 2025, where each stock is 4 to 5% of your portfolio, is something. If something bad happens to any 1 or 2 stocks, you might still be able to weather that.
Yeah, exactly. Okay, thanks. Okay, so I think now we can kind of move on to portfolio ideas. I'll just quickly move on. I've got 3 here to share with people. First off, I think what I said about Se-Boon being right about ETFs, I totally back him up. If you are starting completely from scratch, you really just want to start putting your money into the market, I think ETFs are a great way to do that. It gets you diversified instantly. So that's the beauty of an ETF. If you have a specific sector that maybe you're a bit more bullish on or you like, such as technology, there's always, sort of an Invesco ETF that follows the NASDAQ. That's a very well-known and very liquid ETF that you could buy into very easily. If you want broader exposure, then you could maybe go for an S&P 500 ETF. That's obviously US focused again. They have a US listing, obviously, but they also have a Singapore listing. So you can actually buy the Singapore shares as well. And if you want that China exposure that Se-Boon was talking about, I think technology in China is really a key area that you want to have a look at. And there's a great ETF in Hong Kong that's run, I think, by BlackRock, and it's got a very low expense ratio, and you want to be looking at the expense ratio and how much they're charging you to buy that product. And there's a really reasonably priced ETF that tracks the Hang Seng Tech ETF, which is a basket of up and coming technology stocks in Hong Kong. And then finally, I think all the talk of the past 10 years of the US outperforming, there's been the international markets that have been kind of ignored. The stocks maybe in Asia and then also in Europe. And so I think the Vanguard Total International Stock ETF is actually a good option if you're looking outside the US. And that ticker explains it, right? It's VXX-US, basically. It's basically X, the United States. And that gives you a bit more geographic breadth, I think, than concentrating too much in the US or just in China. Okay, so going on to the stock ideas. First one for me, I think is really important is you kind of want to own one of the leaders. You want to own leaders in their respective niches or their respective spaces, right? And so PayPal is one of those. It is the digital payments leader. In the last quarter alone, it had processed about $285 billion in payments. So if you look at the past 4 quarters combined, if you look at 2000 sort of Q2 to sort of Q1 2021 Q2, you're looking at close to $1 trillion, right, annually. So obviously, I think this year they'll surpass $1 trillion annually in payments. So that is an immense amount of growth there that PayPal has. And the great thing about PayPal as well is that it is an international play, which I really, really love. So I think a lot of people think of the US as just US companies and they only generate revenue from the US. And if the US economy is not doing well, then these companies can't do well either. But actually, that's not true for PayPal's case. It is a truly global business, right? So it actually processes a lot of payments cross-border, and that is becoming a big, big part of its business. And recently, it has announced plans to launch in China, but focused more on cross-border commerce. So they won't be competing with the likes of Alipay or WeChat Pay. They will be focusing more on the international cross-border commerce payment space, which is really, really fast, and it's growing quickly as well. And then, this is the generation, right? This is the millennials, the Gen Zs. Like, what are banks? The banks, what are they? It's more like instant transfers of money. Everything is now on your phone, right? So if you haven't got a good app, or if you haven't got instant payments, you're going to be obsolete. And so I think that's partly why in Singapore, the Pay Now and the QR codes and everything that have popped up is it's been a really good push from sort of digital players to get banks here starting to innovate more. And so that's a great thing. And I think PayPal's been at the forefront of that. It's been one of those big sort of innovators in the digital space, into digital payments. And finally, I think it's just got rock solid cash flow, right? It's got cash flow. And when I look at companies, I like to focus on the quality of its business. And the quality of its business comes down to two words for me. It's cash flow. And cash flow in PayPal's case is immense. It is huge, right? It's a really, really strong company that's generating a lot of cash. And that eventually, is going to flow down to the bottom line. So I think that is something that you've got to really keep an eye on when you do look at companies, is what is their free cash flow? Are they generating money that can, eventually, drop down to the bottom line? That's a key component of it. So that's my number one idea. I don't want to spend too long and bore you on these with these slides. So I'm gonna shoot through. Number two is something that Seiboon alluded to, is start local, be a bit more closer to home in terms of what you're buying and what you're thinking about investing in. And Mapletree Industrial Trust gives you that property exposure in the form of a REIT, which is a real estate investment trust. And the great thing about a REIT is you can have access to multiple tens of properties through a share, right? Basically, you buy a unit or you buy units and you get exposure to the rents that are paid to all these properties. And as you can see with Mapletree Industrial Trust, it has over 100 properties, right? And they've been growing their North American portfolio quite quickly. And that has been focused purely on data centers. And I don't know if a lot of people are aware of that, but data centers are basically pandemic proof, as we kind of saw last year, right? Basically, people who were technology companies who were leasing these out continued to pay, and it continued to be in demand as everyone used data, and it became obviously a hot property. And so that's something that they've actually been investing in since 2016. So they've been quite prescient in investing into that sector from an earlier stage, and it's obviously paid dividends for them, so to speak. And that's kind of led to outperformance, right? So as you can see, the unit price at IPO back in about 2010 was at 93 cents. It now trades at about 280, right? So it's about tripled, but you're also talking about your distribution, which you can add on another 120% on top of that. And as you can see, it's completely crushed the FTSE REITs index, and it's also crushed the FTSE Straits Times index, which has been a poor performer over the past 10 years. And that's meant growing distribution. So as I said previously, I like to see a line that goes up and goes up and to the right when you're talking about dividends, right? I don't like dividends that go up and then down and then up and then down. You want dividends that keep going. And there's a little blip there, as you can see, for the pandemic, but it sort of came back right back up again. And it was a lot better off than a lot of these other REITs that saw their distributions fall 50, 60, 70%. Their distribution fell about sort of, maybe about 6, 7% year on year. So it wasn't a huge hit to them. And it looks like they're kind of getting back onto that growth trajectory as well. So I think at this point, I want to hand over to Se-Boon, because I think Se-Boon's got his own REIT that he wants to share with everyone, one of his favorites. And so Se-Boon, I kind of put this onto you now, if you don't mind taking over.
Okay, thanks, Tim. So our research team, they have a whole range of REITs that they have researched and that they recommend as adds, meaning to add to your portfolio. My favorite amongst those that they are recommending as adds is Fraser Centerpoint Trust. So the first slide that you see here now, okay, let me have a quick look. Right, okay, so that's that particular slide. First slide, Fraser's Centerpoint Trust. Now, it's a Singapore heartland play, right? It's about the strength of the Singapore economy and the Singapore consumer. Just about every Singaporean would know its properties. They are household names, right? And those properties have recently been boosted by the acquisition of ARF, or Asia Retail Fund. So the properties are North Point, Tampines One, Hougang Mall, Tiong Bahru Plaza, so on and on it goes. So you would know these household names. And next slide. Note that Fraser Centerpoint Trust has fallen from its January and February 2021, January, February high of this year. The high was then 266. It's come down to 231. I just had a quick look at it. It was 231 today. So that's a 13% decline, 13% decline on this latest wave of COVID infections and your circuit breaker. Now, to me, these are pretty attractive levels to get into Fraser Centerpoint Trust. So you have to ask yourself, will this pandemic never end? My simple answer is yes, it will, and we will get over this. The next slide, please, Tim. So note how Singapore retail sales in general have been recovering, and Fraser Centerpoint Trust tenants' sales have performed better than the general retail market, and the occupancy rates for their properties are either high, very high, or full, or nearly full. Yeah. Okay, slide 4, Tim. So its tenants' lease expiries are fairly evenly spread over the next 5 years, next 4 to 5 years. The weighted average lease expiry is 1.5 years, but that's fairly evenly spread out over the next 4 to 5 years. It's a valuation play. It's a valuation play. As I said, the stock price has fallen about 13% from the February high. And if you look at its price now, 231, it's getting towards that pandemic low. That March of last year pandemic low was $2.05. So we're getting towards there. My feeling is that we won't get there. I could be wrong, but my feeling is that we won't get there. And we are looking at very decent value now. It is trading at book value. You're not paying much more than its book value. And on our research team's forecast distribution per unit, we are looking at a yield of 5% for financial year 21, this financial year, rising to 5.4% in financial year 22. In an environment where we are all starved for rates, for yields, those are really attractive levels.
Yeah,
back to you, Tim.
I think they, both MIT and Mapletree and Fraser's, they kind of give you that yield and that anchor in your portfolio. So I think it's, they're both both solid Singapore plays.
Absolutely.
Yeah. Okay, so last one I'm going to just quickly go through is Microsoft. You know, I mean, it's big tech, it's growing plus 20% still, and it's a $1.7 trillion company. So that tells you a lot about how sort of nimble and fast growing this company, this business is, and it's a giant. I mean, you're looking at the top three sort of businesses here: productivity, business processes, what we know as PowerPoint, Microsoft Word, Office 365, what I'm using now, what everyone uses when they, you know, they're using Word docs or Excel. Everyone uses that every day, and that's one thing that we can't live without, right? And then number 2 is intelligent cloud, and that's growing at over 20% as well. And that's your cloud computing business, your Azure. So number 2 to AWS globally. And it's been pushing really, really hard against Amazon in that area. And then finally, you've got your more personal computing, which includes, you know, the Surface Pros and the Xbox gaming consoles, which has now started to morph into more of a subscription service as well with its Game Pass. So you're looking at recurring revenues on all kind of fronts, and just a really, really strong balance sheet, over sort of 70-80 billion in cash. It's just cash rich. It's a real stalwart of the technology scene. And what I like about it, I think, is it's probably the least prone out of all the tech giants to antitrust. You know, it's reformed itself since the bad days of 2000 with Windows and Bill Gates and all that antitrust investigation from the Department of Justice. It's a reformed giant, right? And it's really flying under the radar for most antitrust and anti-competitive investigators in the US. They're not really looking at Microsoft, and Microsoft continues to make money, and a lot of money. And it's got a compelling cloud angle, as I said. And I think this is really, if you want the cloud exposure, and if you believe in the rise of the cloud, Microsoft is one of those leading companies that you can count on. And it again can provide an anchor in any portfolio if you're starting. It's one of those that will be here in 10 years, will be here in 20 years, and I'm sure it will be as big as it is today, if not bigger. Okay, I think that's wrapped it up for us. I think I just want to run one last poll before we hit the Q&A. Let me just see. Okay, poll one again. Okay, maybe not. Okay. Relaunch. Okay, no, I don't think we can. Are we running the last poll? I think someone is. I think our team is going to run the last poll. Yeah, they are. Okay, so after this, which of the following products are you contemplating adding to your portfolio? Oh, wow, okay. All right, give it another 5-6 seconds. Okay. Yeah. All right. Interesting. Okay. Yeah, I think we'll end the poll here and kind of see. Let's see. Okay. So we can kind of see REITs is top. I think it's a good one if you're starting out in the local market. Definitely is the REITs are a great area to look at. And stocks and ETFs running close, and last is mutual funds. Okay, so I think we did a pretty good job there, Sabun, of selling REITs as a potential investment. And before we move on to the Q&A, I think I kind of want to make sure that everyone, I think, put your questions in there if you want. And also, check us out for the upcoming sessions. We've got myself and Sabun again on portfolio goals on the 17th of June. What we're going to be looking at is, should you be going with growth stocks or should you be going with income stocks when you invest? Or should there be a combination? Who knows? And what are the pros and cons of each, right? I think that's something that everybody should be aware of. There are pros and cons to each of those approaches, and we should be fully aware of them. And finally, every investor is going to be different. Everyone will have their own preference and their own style, and there's no right or wrong. It's just understanding what you're comfortable with, what you're more familiar with, and what you like, right? And then I think from there you'll be able to understand where you see the opportunities. And then second, thirsty for stocks. This is more of a stock-oriented educational webinar looking at businesses and how we should value them, how we should look out for winning businesses, and what are the key metrics that we should be looking for when we understand what we want to invest in if we're looking at individual stocks, and also why the sectors that these businesses operate in are so relevant to their prospects as well. Okay, so thanks for that. Thanks for tuning in. I mean, Q&A now. I think we're ready to take Q&A. Ping.
We have a few questions lined up, so cool. I think we got the questions coming up. Okay, so we're still on the topic of REITs, and I think this is a follow-up question for you, Se-Boon. Do you see FCT rendered obsolete in the long run as a result of the pandemic?
No, that's a very simple answer. Well, you've got to assume that the pandemic will never end to decimate the thirst for shopping, right? So what can be a greater threat is not the pandemic, but the digitization of retail, right? That is a greater threat, a long-term threat. Now, I have thought about this long and hard, and I have come to the conclusion that that digitization of retail is a long-term threat for all retailers and all retail REITs. But retail REITs are not just about shops. They're also about an experience, right? And increasingly, shopping malls are giving more and more space towards food and beverage. So people are as much going to a mall for the experience of dining out and then walking around, having a look at shops there as they are in purely buying. So I am, and I have become a retail, online retail shopper over the past 14, 15 months, right? So because I can't travel much. So I now go online to buy stuff that I used to be able to buy when I travel, right? But I still go to shopping malls. So I live in Melbourne now, right? So I still go to, and I live very close to Chatston, those of you who know Melbourne. So I go to Chatston a lot because it's just a total experience. So I like going there. They have a Papa Rich. They have a Papa Rich in Chatston in Melbourne, and I go there for my char kway teow, right? So it's an experience. And when I go there as well, and I sometimes like shopping online for things that I can't get, but things that I can get here, I like to go in there so I can try it out. You know how you buy stuff and you say, "Oh, hang on, the sleeve is too long," right? So I still think it'll be around. I'm not so worried about that. And if you think about Singaporeans, they love going to shopping malls to makan, right?
Yeah. I think I would add, no, I agree. Like, I think there is long-term, there is a threat, but I think more in the short term, I think commercial properties are actually more at risk just because of the way that we have changed work. I don't foresee the end of commercial properties and all these people saying that the commercial properties are dead, because they won't be. They'll just be a hybrid model. There will be some flexibility, but the key thing is that demand for space will fall. It won't fall. I don't think it will fall completely, but it will definitely not be as strong as it was pre-pandemic. And I think that's something that you're seeing in some areas in Hong Kong already. You know, people are moving out of Central. They're moving into other areas where there's office space that is cheaper, like Tai Koo or Quarry Bay, or Kowloon East. They're a lot cheaper, and you don't need to be in Central in Hong Kong, which is the business district. You don't need to be there. If you have properties that are outside and are cheaper, you can be there, and you can run a remote workforce, or you can run an office or a pared down office for a much cheaper sort of overhead. So I think commercial, is much more at risk than retail. But I do agree with Se-Boon about retail kind of having
even commercial, Tim. I feel that the threat is bigger for countries with a large suburban sprawl,
Yeah.
right? Rather than for Singapore and Hong Kong, which are
Yeah.
small cities,
Yeah.
relatively small, not small in terms of population, small in terms of its geographic spread, right?
And that's also,
So it's less so, but when you go to Sydney and Melbourne or the US, where there's a big suburban sprawl,
yeah.
the risk is that there will still be commercial space, there'll still be commercial REITs, but they may be the ones that are further out, right? In the suburban sprawl.
Yeah, true.
All right, thank you so much for that answer. Let's have the next question, please. Okay, yeah, this is an interesting one. You say never borrow to invest. Do you stand by this advice if interest rates are low and one's cash position is strong enough to cover it? Now, I think leverage and borrowing to invest is always a topic where you will get differences in opinions, because some people are comfortable with it and some people are not. So let's start with you, Tim. Why don't you explain to us why you do not encourage borrowing to invest?
I think mainly because, I mean, I've heard this argument a lot as well, is that, oh, I can borrow at 2% and this REIT is, or this stock is yielding 4 or 5%. So my return is effectively 2%, or I'm getting 2%, spread. That's great, but you're going to have to rely on that stock not crashing or not, or performing as it is, and that yield continuing to be paid out. And taking on that risk, is it really worth the risk for that extra yield, unless you're putting in hundreds of thousands of dollars to get that extra 2% yield? I don't think it is. And then with the interest rate environment now, everyone's talking about inflation and rising rates. That could, impact your ability to repay. But beyond that, if we're talking about margin, that's when you can kind of get into, I think that's maybe different to a straightforward loan. But if you're talking about margin borrowing to start investing and trading, that's where it can multiply. And the multiply effect is when you can start losing a lot more money than you've put up. And that's when you get margin calls. And that's when your capital is completely wiped out, right? Or you're going to have to owe more money because you've leveraged or you over leveraged. And I don't think from an investment perspective, it's necessary. When we talk about don't spend beyond your means, I think that should apply to investing. Don't invest beyond your means, because we say don't spend. So why should we have a different mentality when we invest? That's my own personal opinion. I know, people will disagree, but it can get you into a lot of trouble. And if you're putting away money every so often and you're doing it responsibly and you're getting a good return over the longer term, I don't think there's any reason to take risks of borrowing to eventually to make a few extra percent.
Sabun, what is your view on this?
Well, I am less opposed to leverage, to leverage or borrowing for investments. Call it whatever you like. Leverage, borrowing, margin, it's all the same thing. You are playing with OPM, other people's money, right? You're borrowing somebody else's money to leverage up your returns. It can be a very, very powerful tool, but it can also be a very destructive tool. I'm not philosophically opposed to it. The leverage is a very normal part of trading and investment, but you just got to know what you're doing. Normally, I do not recommend it for newbie investors, right? So, and if you are very cash strapped, you're on that sort of 20% margin, and the stock falls, you get a margin call, and you're unable to hold on to it. That's where the danger starts, right? But if you borrow less than that, you have a larger sort of a buffer for stocks to fall, and you don't get called. It's not an unreasonable thing, right? It's not an unreasonable thing. You just got to know what you're doing. You can't leverage up to the hilt that any slight movement in the stock price causes you a margin call, right? So those are the things you got to think about. The one more thing you got to think about, less so in Singapore than in maybe the US now, is the risk of rates rising, and that could be a problem in coming years. So I'll stop there.
Yeah.
Thank you so much, both of you, for your views. Let's have the next question up. I know we're running out of time, but I think we can Okay, this is a good one. Given the risk of inflation and rising interest rates, what measures can we take over the next 6 to 12 months? Now, this is definitely a hot topic, and I think, Sabun, you just released your first big money article and video today exactly on this topic. Do you want to give us a quick summary?
Sure. The quick summary, the quick of it is simply this. The initial stages of rising inflation is not necessarily bad for stocks, right? It is bad for stocks if you have rising inflation and no growth. But when you have rising inflation and also very high economic growth, like what we're seeing now, that is what I call pro-cyclical inflation. That's not a bad thing. Stocks can go higher. Stocks can go higher during the early stages of the rise in inflation. Where stocks start to fall is in the later stages of that rise in inflation, when interest rates and bond yields start to go up. Then it strangles off economic growth, and the bond yields get so high that it no longer makes sense to buy stocks. That's when stocks crash. So right now, over the next 6 months, as you're saying, 6 months, I will stay with stocks. I will stay with stocks. I would definitely not be in bonds. This is a terrible time to be in bonds. It is a dumb time to hold bonds. Just be in stocks, and as we progress towards the end of that 6 months, I'd start thinking, in fact, you should start thinking now, in fact, about buying some inflation hedges, right? Oil, commodities are what I call good inflation hedge. So in other words, the early stages of the recovery should be good for commodities and oil, because that means the economies are growing, right? But the later stages, when inflation gets to be toxic, you want to have gold, all right? You want to have gold. So think about that. Stay in stocks, start to diversify a bit into gold and commodities.
Okay, thank you very much, Sebun. Let's jump to the next question. And for those of you who want to see the full long answer, we'll share the link of the article.
Could I touch on that? Could I touch on the inflation bit as well?
Oh yeah, sure. Go ahead, Tim.
I think my initial reaction is like, I think, yeah, you do need to be selective, I think, in what stocks or what sectors will benefit. I mean, I think Zibun is right with, they're going to be real estate, commodities should technically benefit, banks, insurers, but be very selective with which ones you're going to be in, because, a lot of these cyclical names have been value destructive over the past decade, right? But they should benefit technically. But that doesn't always pan out, over the 6 to 12 months or even over the long term. I'm much more in the deflationary camp. I think technology and productivity gains will probably keep inflation controlled. And then finally, we've been aging as a demographic, like globally, for the past 2-3 decades. And that is going to continue because China is aging rapidly aging. And as we know, aging populations are deflationary. They spend less, and we're living longer as well, right? So I think these things over sort of multi-decades, we're going to have to take into consideration. But over the next 6 to 12 months, I think Sebun is right in that these things that should benefit short term. But in terms of your investment and how you think about it over the long-term horizon, I think we should think about things over sort of 5, 10, 15 years. And keep your eyes on the prize and just continue to invest in good companies and in good economies as well.
Okay, thank you, Tim. I think we had a question on DCA, right? When one DCAs, is it advisable to put that sum into the same assets, or should I vary the assets I invest in every quarter? Tim, you want to take this one?
I think if you're young, I think there is not really any reason to be in bonds at this point. I think Sebun's right. When you get a bit older, that there's definitely reason to be in bonds, but yields at the moment on bonds are just, it's as, as what Ray Dalio says, it's like, bonds are like no point being in bonds actually. And then cash is trash. There's no point holding cash either. So you basically have no other option. That's Tina, right? There is no alternative. You have to be in stocks. If you're 20, there is no reason to have, I think, any allocation to bonds. If you're sort of 40, 50, I think there's definitely a reason to be in bonds, and you should be, but I don't think you should have a very high allocation to it. I don't know what the allocation should be. That's not for me to say, or, that's a personal opinion. But I'm much more towards owning assets that are actually going to sort of produce cash flows and actually going to pay you and grow over time. And if you've got time on your side, then stocks is the best asset class. And it's proved to be the best asset class over the sort of past 100, 200 years versus bonds and gold. So I think, if you're looking at DCAing, I would say in the same asset class if you're 20 or 21 or in your 20s. If you're older, maybe think about switching it up every so often. But even if you're older, we're starting to live longer, right? There's this book that came out a couple of years ago about the 100-year-old life, the 100-year life. Everyone is starting to live to 100. It's almost normal now. So being retired at 65, 70, you've got a good 30, 40 years maybe you could expect to live. And by the time, we hit sort of 2050, 2040, 50, what's the average life expectancy going to be then, right? So you've got to think about your retirement funds and where you're going to be are you going to be working longer? Are you going to be working until you're 70 because you like it, or 75 because it's out of necessity? Or are you going to have enough funds to retire at 74 that are going to last you until you're 100, 110, right? So these are all sort of factors that need to be considered when you're looking at asset allocation. And it's becoming a much more important factor, I think, nowadays because of how long we're actually living and how low yields are on bonds. And unless that changes dramatically, I think for me, stocks, it has to be majority stocks.
Okay, thank you very much. We have, I understand, 3 more questions. So let's see if we can quickly go through all 3.
Yeah.
Okay, I think this one came in from one of our FB viewers. Back to REITs, hot topic as always, REIT. What about Ascendas REIT compared to Mapletree? So Tim, since you picked Mapletree, perhaps you want to comment on Ascendas.
I just see as Ascendas, for the lack of a better word, like second tier. I just don't think it's as good as a Mapletree. Mapletree as the parent and its management, their execution, their DPU growth is just superior. Let's take the latest example of acquisitions, right? Ascendas bought, I think, 9 or 10 data center REITs in Europe for 900 million. And Mapletree Industrial Trust actually announced an acquisition last week, actually just before I started this after I started this presentation on Mapletree Industrial REIT. And when you look at acquisitions, you're looking at pro forma DPU growth. So they take into account how much is the DPU going to grow with this acquisition in the portfolio, right? And consistently, Mapletree Industrial Trust, their pro forma DPU when they make an acquisition is solid. It's above 3%, it can be above 2.5, 3%. So for Mapletree Industrial Trust's latest acquisition, their pro forma DPU growth that they had modeled in was 3.3%. For Ascendas REIT, it was like 1.1, 1.2. And so that's a consistent track record that I see with Ascendas REIT in terms of their growth of their DPU. It is just subpar. It's just not as good. And if you look at the data and go back and look at it, that the data just tells you that. So it's not something that a lot of people maybe think about. But if you just go back and look at that track record again, does it go like this, or is it kind of? And as I said, I like this because that for shareholders and unit holders is superior, and it will show out in the unit price appreciation. And I don't have the figures, but I'm sure it does. I think it does. I think Mapletree Industrial Trust is probably one of the best performing REITs in the past decade.
Okay, thank you very much, Tim.
Yeah.
Okay, last 2 questions. The next one. How does one select an ETF given that it is a bundle of stocks rather than a single stock that can be fundamentally analyzed? Sebun, would you like to take this one?
That's very easy. Essentially, so there's no stock selection involved in an ETF, and that was my point, right? So unlike specific stocks, when you have to analyze, is Ascendas better than Mapletree, right? You don't have to think about that with ETFs. You choose your markets. And then you find an ETF that captures that market, that mirrors that market, right? There may be more than one ETF that mirrors that market. Okay, there may be more than one. If there are more than one, there's more than one ETF that mirrors that market, essentially then have a look at how closely the ETF tracks that market, right? What the tracking error is. So you don't want an ETF with too big a tracking error. So a too big a tracking error may mean that their expenses are a bit too high, right?
Yeah.
Okay, so just choose your market. So if you like the Singapore market, and I'm not here to plug any particular ETF, right? So just go look at the ETF that tracks the STI, the FSSTI, and just look at how closely it tracks the performance of the FSSTI. If it tracks it, then that's the one you want, right? So it's all about market selection rather than ETF selection, if that makes sense. Yeah.
Yeah.
Thank you, Sibun.
I would add, like, just make sure you understand what's in the ETF as well. I think that's a really key component that I kind of brought up on a previous webinar is, a lot of these track indices that are maybe not very well performing or that have a lot of bad companies in them. So I think you need to be really cognizant of what's in the ETF. That's also very important.
Yeah, so you'll find that's right, Tim. If it's plain vanilla, it's easier. If it's a Straits Times Index ETF, it's a lot easier. But you have these days the so-called smart beta ETFs, which can be quite funky, right?
Yeah.
Be quite sort of unusual stuff, doing really funky stuff. They are mixing and matching stuff, and then they create their own index, right? You create your own sort of specialized index. So you got to know what's in it, right? So from plain vanilla to quite tailored sort of indices on which then people write ETFs. So you just got to know what's in them.
Mm.
And I just want to point out, I think Tim actually shortlisted 4 ETFs earlier in his presentation. So hope you took a picture of that, so you at least already have 4 options to pick from. Okay, now the final question for tonight, which I actually like a lot because it's a little bit of a ESG related question. Any commentary on the oil and gas market? Any upside in light of the environmental push for cars, solar, and wind?
Look,
Tim or Sibun? Okay, Sibun, you go first.
I think Sibun wanted to jump in. Go for it.
Yeah. Look, over the long term, again, very much like how online shopping over the very long term is a big threat to shopping malls. They have to evolve. They have to become more experiential. You're going there to watch a movie. You're going there for dining. And by the way, you might buy a few things, right? Okay. The threat from environmentally sustainable sort of options is a long-term threat to oil and gas. Totally agree. But I don't see it as a threat over the next 10 years that I can see, in the sense that, take for example, electric cars, right? It's a great idea. But right now, you will probably have to stand, if you don't have a charger at home, a high-speed charger at home, or if you forgot to charge it before you go to sleep, a bit like your phone, darn it, I forgot to charge my phone. I forgot to charge my car, right? You'll be standing there. If you can find a charging station. Some countries like Australia don't have a lot of charging stations, right? When you find one, you're gonna have to be standing there for 1 hour, even with the high speed, the charger, with over a few cups of cappuccino and very trendy, and you could be standing there with your latte, making friends with other electric vehicle owners who are queuing up to charge their cars. So look, near term is not a threat. Right now, the surplus production has been reduced so much that according to the EIA, the supply-demand equation for crude oil has essentially narrowed to the point where it's about to meet. And according to the EIA, demand and supply will meet in the third quarter of this year. and thereafter it may fall into a deficit situation.
Yeah. I think from myself, I'm much more maybe like the millennial. I'm like very anti big oil, just because the returns have been absolutely horrid the past decade. They've lost, I mean, some in China have lost 80% of their value. So they're classic examples of value destruction. And I think last year has really changed the game. It's kind of changed the scenario of how people think about clean energy and oil and gas. And you're kind of seeing that come through with some of the larger American companies as well. They're, the European sort of big oil companies like BP and Royal Dutch Shell, they're starting to actually transform their businesses or think about a future beyond just fossil fuels. And they've got it, they've kind of gone ahead and started exploring the options and they're being pushed by stakeholders to do that. And the Americans, the Americans like Chevron and ExxonMobil, they're way behind and they're kind of buried their heads in the sand kind of thing, don't want to change. And you're kind of seeing that play out in their share prices, which are being crushed. And so I think the key thing is that in 2009, I like to use this example because it's so true. In 2009, 2010, when everyone was talking about renewable energy, it's a game changer. And it didn't change the game because it was still expensive. But now you're seeing solar come down below cost of sort of coal and gas and oil. And the only thing I think, in my own personal opinion, that's holding solar and wind back is that it's renewable, but it's not reliable at this point because there's not that storage capacity to make sure that it's reliable at all hours. Once the battery technology catches up and storage capacity is reliable and it can be distributed reliably, I think fossil fuels are pretty much done in terms of electricity generation and battery storage and battery power. So I don't know when that will come. That might come in 5 years. That might come in 10 years. Until then, definitely, fossil fuels, of course, will be part of the energy mix. There's no doubt. But is it structurally going to be a good story to be in? No. Would I get back in? No. I mean, I haven't been in the past 10 years and I've been glad because it's been one of the worst sectors to be in. And it's been painful for shareholders. And I don't know, I don't see a road back for it over like 10 years or 15 years. I don't see it becoming a big part of our energy mix in 10 years because you're seeing that global push now for decarbonization. You're seeing that global push for the planet. And I think 2020 was a real sort of watershed moment and watershed year for that change in the mindset globally. And I don't think we're going back. It's the same with online shopping. It's the same with digital work from home. We're not going back. So I think for me, it's a no-go for big oil, especially in the US.
Okay, thank you very much, both Tim and Sabun, for your views. I would just say this, as a millennial, the next car I buy will be an electric vehicle. All right, and with that, I think we're done for tonight. So thank you so much. I know we've overrun by about 18 minutes, but I hope all of you enjoyed the session as much as we did. So thank you again for joining us.
Thank you, everyone.
Good night. Stay safe.
Cheers. Bye.
See ya. Bye.
Bye. Bye.